Cap rate, capitalization rate, is a key metric in real estate investing used to measure the potential return on an investment property. It helps investors compare different properties and assess risk before purchasing. What is cap rate? Cap rate is the percentage of return an investor can expect from a property based on its net operating income, NOI, and purchase price. It is commonly used for rental properties and commercial real estate. Formula: cap rate equals net operating income divided by property value times 100. Example: if a property generates $50,000 in annual net operating income and is valued at $1 million, the cap rate is $50,000 divided by $1 million times 100 equals 5%. This means the investor can expect a 5% return annually based on income from the property, excluding financing costs. Why is cap rate important? Measures investment return. Helps investors evaluate potential rental income versus property cost. Compares properties easily. Investors use cap rates to decide between multiple real estate options. Indicates risk level. Higher cap rates, above 8%, suggest higher risk but potentially higher returns. Lower cap rates, below 5%, indicate lower risk with steady income but smaller returns. How to interpret cap rate. High cap rate, 8% or more. Found in riskier markets with less demand. Example: a property in a less desirable neighborhood may have a 10% cap rate, meaning higher returns but greater risk. Low cap rate, 5% or less. Common in prime locations with strong demand. Example: a rental property in New York City might have a 4% cap rate, offering stability but lower income relative to price. Mid-range cap rate, 5% to 8%. Found in balanced markets with moderate risk and return. Factors that affect cap rate. Location: high-demand areas usually have lower cap rates. Property type: residential, commercial, and industrial properties have different cap rates. Market conditions: economic trends influence rental demand and property values. Operating expenses: higher maintenance and management costs lower net income, reducing the cap rate. Example of cap rate in action: a real estate investor is deciding between two properties. Property A costs $500,000 and generates $40,000 in annual NOI. Cap rate equals 8%. Property B costs $1 million and generates $50,000 in annual NOI. Cap rate equals 5%. Property A has a higher cap rate, meaning a higher return, but might come with more risk. Property B has a lower cap rate, indicating a safer, long-term investment. Limitations of cap rate: does not consider financing. Cap rate ignores mortgage costs and loan payments. Only a snapshot of value. Real estate markets change, and cap rates may fluctuate. Not always the best investment measure. Other factors like property appreciation and tax benefits should also be considered. Quick recap. What is cap rate? A percentage that measures the expected return on an investment property. How is it calculated? Net operating income divided by property value. Why is it important? It helps investors compare properties and assess risk. What does it tell you? Higher cap rates mean higher risk but better returns. Lower cap rates mean lower risk but less income. Cap rate is a valuable tool for real estate investors, but it should be used alongside other metrics to make the best investment decisions.